Meanwhile, those floods in the Midwest are hurting the U.S. Farm Belt. The extensive rains have kept farmers out of their fields, so plantings are being delayed. In fact, this is turning out to be the slowest corn planting season on record, and that in turn is lifting the price of various agricultural commodities. For this month alone, corn futures are up about 15%, wheat futures up about 13%, soybean futures have gained about 2%, but there's less concern about that crop because it can be planted later.
Scott Nations joins us now to talk more about the impact of those Midwest floods on crop prices and what potentially it means to you. He is President and Chief Investment Officer at NationsShares. Good to see you, Scott. Welcome back.
Thanks, Sue.
You know, farmers have been on a wild ride just in the past few months. In May, we saw soybean prices hit a 42-year low on the trade worries. And now, as Bill just mentioned, in 1 month, we see a 21% increase. Where do these prices go from here?
Well, Sue, given the fact that the Department of Agriculture has told us that only about 58% of corn acreage is planted, this time of year we would expect 90%. I think you have to expect some more inflation in commodity prices. Not only does that corn acreage number mean that less corn is going to be planted, it also means that the yield from the acres that do get planted is going to be disappointing. So corn right now, just over 20% off its recent low. We have to expect additional price increases. Also, the floods are going to have a perverse impact on shipping.
Right.
So much corn is shipped via the Mississippi River, and the floods are going to mean that there's less capacity for that. So it's going to hurt farmers on a couple of different levels.
Now, on soybeans, we were talking about, we've already had an oversupply of sorts because China has not been buying as much soybeans in the past year because of the trade concerns and the tariffs. So are we expecting that much planting to occur this year anyway?
A lot of farmers have scaled back their plans for planting soybeans. But to your point, soybean prices are also up more than 20% from their highs, largely because of the news. So to a certain degree, corn and soybeans for many farmers in the Midwest are fungible. That is, they can plant one or the other. So you would expect some price increases from corn to bleed over into what we see in the soybean market.
How much of this trickles down to the consumer?
Yeah, Sue, great question. Everybody wonders about that. Farmers do a wonderful job. And so unfortunately for them, and fortunately for us to a certain degree, the food inflation will probably be muted because the price of the actual commodity makes up a relatively small portion of the price that you pay at the supermarket. In addition, energy is a very big portion of the input cost. And we've actually seen both crude oil and gasoline prices fall quite a bit this month. In May, we've seen crude oil prices drop about 7%. Gasoline, not quite as much. So lower energy inputs are going to keep a rein on some of the food inflation we might see otherwise.
Scott, always a pleasure to have you with us. Thanks so much. Scott Nations with NationsShares.